Folks, in today's video, I'm going to talk about sector rotation, and I'm going to explain to you how sector rotation can actually help you with risk, why it's important, when you should look at it, how you can utilize it, how you can help you protect yourself, and how it can help you focus on the big picture. And by helping you focus on the bigger picture, look into the smaller picture and look at things in a very, very systematic fashion. And a lot of people don't understand this, so I'm going to go through it step by step. So right now we're looking at the S&P 500, and the S&P 500 has been going down for a few days now. It peaked out about, let's see here, on the 17th. Today's the 23rd, 5 trading sessions ago. And it's been kind of cooling off, and the odds are it's going to hit the 50-day moving average. And if you look at the QQQ, which is the NASDAQ 100, which looks at the top 100 NASDAQ stocks, that's the large cap tech sector, you will see that it's actually trading below the 50-day moving average, if we can ever get these charts to load up here. Anyhow, it's abutting the 50-day moving average. And I call this the twilight zone because when stocks are trading between the 50-day and the 200-day moving average, they tend to lose directional bias and they tend to just kind of shuffle around. And we could see that by looking at StockFetcher right here. Let me go to the 10 sectors. So right here, this table, these are, you can count, it's 10. Now, technically there's 11. There's information technology or internet technology. I don't play that game. I just go with the 10 major sectors. And I'll click this button, and this is my CSI Cumulative Strength Index scanner. And it looks at strength over a 1 month, 3 month, and 6 month basis. So it gives us a good understanding of how not the NASDAQ, but the S&P 500, the SPY. SPY is the ETF that tracks the S&P 500, how it is looking internally. Because remember something interesting, there's 500 stocks in the S&P 500. What if we find out that, and they're all capitalized weighted, which means the bigger the company, the more power it has to control price action. But it's much better, but it doesn't really tell us which stocks are moving higher, which stocks are moving lower, which is there a specific trend moving or not. It just tells us the cumulative price action. And it's, it's kind of humming along. It's above the 50-day moving average. But let's look at it internally from an inside out. This is like looking at a car from an outside going around the track. And this is like opening up its engine and looking under the hood to see what's ticking, what's humming, what's causing the noise, what cylinders are firing off, and so forth and so forth. So as you could see here, the energy, the financial, and the industrial sector, these 3 sectors are the 3 leading sectors. And you will notice technology, NASDAQ 100, utilities, consumer staples are the lagging sector. Now the first thing that pops out at me is the fact that consumer discretionary is away from technology. Typically, you will see industrial next to basic material. Sometimes basic materials will be above industrial, and sometimes industrial will be above, but they're next to each other usually because industrial stocks and basic materials, they kind of go together. And you will see the same thing for utilities and consumer staples. Think about it. Consumer staples, utilities, they're related. They're both very defensive. But technology is always next to consumer discretionary because think about it. Now, Amazon is Apple. Are they tech companies or are they consumer discretionary companies? They're kind of both. Now, chip stocks, they're kind of on their own, even though they're technology. But for the most part, there's a big interrelationship between consumer discretionary and technology. And right now, you could see that healthcare is in between them. And that's telling us that there's a fragmentation there, which you can also see by looking at the QQQ. Because it's below the 50-day moving average. So we're able to see it by looking at it from the chart, by looking at the fact that it's fragmented because tech is not next to, see it's trading below the 50-day moving average, it's kind of trailing between, but we can also see technology is one of the bottom 3 sectors. But this is big, and I'll tell you why. The S&P 500 has 500 stocks, okay? And if you look at, for example, let's look at it over a 1 month basis. If you were only in industrial stocks, you would have gained 6.55%, okay? If you were I'm just giving you an extreme example. Let's say you were in industrial stocks and technology stocks. Well, technology stocks lost 3.01%. So if you were in industrial stocks and technology stocks, you would have made 6.55% here. Trust me, I'm going somewhere with this. And you would have lost 3.01. So you would have made a net profit of, instead of 6.55%, you would have made a profit of 3.54%. Still a profit, but about almost half as much. But what if, check this out. This is where it gets really cool. What if I can go long on industrial stocks and I can short the technology stocks? You can buy put, or you could just sell short. Just buying an at the money put. And we could teach you how to do it. It's not hard. But the point is, what if you sold technology and bought industrial? You would have made not 6.55%, not 3.54%, but you would have made 9.56% in 1 month off of S&P indexes. You see where I'm going with this? So the point I'm making is you don't have to trade the entire S&P 500. These are all ETFs. These are all ticker symbols. XLI, XLK. Here, let me show you. XLI, for example. This is the industrial sector right now. And you'll be able to see its representation, and I'll bet you over the last month, it gained what, 6.55%. Look at that. Whoop, moving up. Not bad, right? Nowhere near the 50-day moving average. Where technology, if we look at technology, you'll see that it's really holding the index back. So the point is, what if you could eliminate that technology? Look at this. See, trading below the 50-day moving average. As a matter of fact, if you look at XLK and you look at QQQ, you will see that they virtually look identical. So last year and the first few months of 2021, having technology was your friend, but lately it looks exactly the same. Look, QQQ, and now we're looking at XLK. They're identical. Virtually identical. And the point of the matter is, what if you could now leverage that by shorting the technology sector and going long industrial stocks? How about this? What if you go long industrial stocks and energy stocks and basic material stocks and you short technology stocks? Look at that. You get all the good stuff. Or how about shorting consumer discretionary and technology and going long industrial and energy? The point I'm making is, you don't have to be stuck with the S&P 500. There are various sectors. And over the last 6 months, if you look at it on a 6-month basis, as a matter of fact, let's go back to a time machine. Let's go back 6 months, okay? This is we're now in September 2020. Let's look to see what led. Let's see, technology wasn't doing well there either. Look at that, that's kind of odd. So that's strange. Oh, I guess it doesn't do it in that order. It only looks at the average performance. Technology was at 19. That's weird. Let's go back today. Let's go back 3 months. How about that? 3 months, let's see. Technology was in 4th place. It was already lagging. Technology's been lagging since September. Let's go back a year. Let's go back to today. I love this time back machine. Let's go back a year. And if we look at it from a year, technology, I guess a year ago would be March. Yeah, that's when the market sold off. Let's go back a month. Let's go back. I'm not having a good time with this. Let's go back. Let's see here. 2019. No. We want to go to today. And then we want to go back 6 months ago. And then we want to go back 3 months ago. There we go. All right. Now we're where we want to go. We want to go back 9 months ago. So 9 months ago, technology was up 6.77%. You wanted to be in technology. Utilities, not so much. But now, And notice, by the way, notice technology and consumer discretionary. Notice they're next to each other. Notice utilities. Well, their consumer staples and utilities are not next to each other, but industrial and base. The market was still fragmented. But typically, if you go back, let's say a month ago, let's see here, consumer staples next to utilities, right there. You could see it right there. The point of the matter is, you don't have to look at the S&P 500 when you have individual sectors. And the best way to look at individual sectors is by looking at the S&P 500 10 major indexes using a relative strength scan such as this. And again, you can use this to see which sectors are leading, like energy, financial, industrial. You could use this to see which ones are lagging, consumer staples, utilities, technology. And if you cut out the weak ones, or if you reverse your exposure on the weak ones, you can profit from both sides of the market or use it as a hedge. And I hope that helps.